Hi, my name is Joe Rzentkowski,
I'm Henry Moritz.
and we're representing Madison Country Day School in the Global Youth Investment Competition. We recommend IBM as a sell.
All right, so International Business Machines Corporation, which you probably know as IBM, exists in the technology sector, providing solutions with three divisions: software, consulting, and infrastructure. The largest of these divisions is software, making up 43% of the corporation's 2023 revenue. Within this division, they leverage hybrid cloud to provide solutions for their clients. In 2023, the corporation generated approximately $62 billion in revenue, with about $11 billion of that being free cash flow. Software and consulting divisions revenue were up mid-single digits. IBM caters to a diverse clientele with emphasis on financial services.
Now, IBM operates in three different industries: software, consulting, and infrastructure. The software industry is made up of a few key players with many smaller players. Now, IBM fits right in the middle. They're not the best at anything, but they're not the worst at anything. The consulting industry is characterized by a very large percentage of small freelance businesses. IBM makes up the 15% of large industries. Now, looking at the infrastructure industry, IBM actually has some more prominence. This industry places an emphasis on physical assets located around the world. Moving on to competitive positioning. IBM offers a package deal, a vertically integrated approach by combining all three elements of these three industries.
So to better understand IBM's competitive positioning, we implemented a Porter's 5 Forces framework analysis visualized here in this star chart. So the competitive rivalry or competition with IBM was rated at a high due to IBM's modest differentiation and the fact that they're fighting for market share against best-of-breed competitors like Oracle and Microsoft. The bargaining power of IBM's customers, however, is considered low due to their on-premise mainframe servers, which have a high cost of switching for customers. The bargaining power of IBM's suppliers, however, is considered very high due to the specialized nature of software developers and consultants. The threat of substitutes or substitution with IBM was rated a moderate, as there are costs of switching that exist, yet there are many more apt solutions for our clientele on the market. The threat of new entrants or new entry with IBM was rated a high, as the infrastructure division does have significant barriers to entry, but as many of IBM's software and consulting competitors are well supported, this makes the broader IT market more accessible.
Now, we're at the part in the report where we tell you why we believe what we believe. Now, this will use evidence from what we just talked about, but also what's coming. Now, we recommend IBM as a sell for a number of reasons. They lack industry-leading qualities. They're not the best at anything. Now, they also have minimal growth. IBM grew about 5% in revenues this year compared to the tech sector at 15%, which is not impressive. They also have a huge debt portfolio. They are 3 times levered, which means they have 3 times more debt than earnings before taxation, amortization, and depreciation. We also ran a discounted cash flow analysis on IBM and found that they are 24% overvalued. And finally, IBM has a lack of innovation. When you're the best in an industry, you have the best employees. IBM isn't the best. They don't have the best software designers. They don't have the best consultants, and this puts them at a disadvantage. Now, keeping in mind the big picture approach, IBM does have a package deal. They have a vertically integrated solution. However, we believe the weaknesses of their business outweigh the positives. Moving forward, IBM has 2 options. They can either invest more in research and development, or they can make acquisitions of other companies. However, while both of these will lead to a long-term value, they will lead to a short-term dip in the stock price. Artificial intelligence considerations, or AI. IBM has had inconsistent growth. You can see on this table that this year they haven't inspired any confidence in their future performance in AI.
So an interesting dynamic about AI, which significantly affects IBM's Watson X platform, is that to stay afloat in this sector, one's software needs to be constantly growing, constantly being developed and expanding, while we can see IBM completely lacks this. which means that there's incentive to invest less and less into IBM's Watson X platform, which then means that it will inevitably fall into obsolescence. And considering environmental social governance, we use Morningstar Analytics Baseline, which rated IBM at a 14.3, very solid rating as IBM adheres to global environmental standards with reasonable sustainability goals.
And IBM's employees are happy, and IBM's management or governance is independent and works hard to be responsible. We found no problems with IBM's ESG considerations.
So here is how we might be wrong. In terms of IBM's hybrid cloud initiatives, their acquisition of Red Hat could prove extremely valuable. IBM's OpenShift does exist as a leading solution for enterprise open software. Then in terms of AI, while we detailed how at the moment it's on a downward trend, there is a possibility that on the horizons, IBM will develop Watson X to be more adaptable across a broad range of solutions, making it valuable. And while there are no tangible results for IBM's R&D, they remain a leader in patents granted.
So we took a bunch of metrics from IBM's annual reports and created some values that we can use to judge how well IBM is doing. Now, IBM has extreme debt. I touched on this earlier, but they are 3 times levered, meaning they have 3 times more debt than they do earnings before taxation, depreciation, and amortization. Additionally, they have negative capital expenditure growth, or CapEx. Now, CapEx is usually used to indicate whether a company is investing money into improving their products. IBM is not. They've had over minus 20% CapEx growth for the last 3 years. Additionally, they have very unimpressive dividend growth. Their DPS per year for the last 4 years has been 1%. So if you owned a stock of IBM last year and this year, you would have gotten exactly 4 more cents in each dividend. And finally, IBM has inconsistent sales and EPS growth. Now, these two usually go hand in hand, but you can see these inconsistent values do not inspire confidence in IBM's future performance. We also ran a discounted cash flow analysis of IBM. Now, the main takeaway here is that IBM is highly overvalued with a 24% overvaluation. We have based this DCF on IBM's lack of leadership, lack of innovation, and lack of short-term solutions.
Continuing with this financial analysis, we have a figure here that illustrates the re-rating which occurred, which is why IBM is now overvalued. So compared to the market, which at market standard valuation is about 20 times earnings at 10% growth, with the tech sector being even as high as 15% growth. But with IBM's 5% growth, this valuation here is excessively high. Another feature about this is that this means that customers are specifically spending more money on IBM's competitors. So IBM's stock price is not justified by its financial performance, which is indicative of a future market correction to align with these historical averages here. IBM isn't the best at any one thing, yet they are fighting for market share on 3 different fronts against best-of-breed competitors.
And that's why we recommend IBM as a sell. Thank you for listening.